Dave is literally a very experienced person with notes, and we're very pleased and honored to have him with us tonight. So take it away, Dave.
I hope I'm half as good as he says I am here. So I do want to, I don't want to start out with an apology, but I kind of owe this group a little bit of an apology because I was actually supposed to speak here about a good year and a half ago, and I had never gotten sick the day of an event, and I was actually deathly ill, and it's probably been a year or so since I was able to get back here. So finally, I apologize to anybody that got stiffed that night that thought I was coming and I didn't. So apologies for that. So tonight's topic obviously is strategic investing in notes. And a lot of this is based on the book, Real Estate Note Investing. Has anybody in here read the book? Nice. I don't have to give out as many, but I actually brought everybody a copy. I'll try to be Oprah tonight and give you all one. And if you want me to sign it, I'll do that as well. And no, it's all good. So it's really a book about strategy and leverage. I think real estate is a finance-driven business, and I think a lot of us lose sight of that, and that there's, you know, a lot of unique things that we could do, right? We can leverage a lot of different things. So finding leverage, right? So think about some of the things you can leverage. I have a business coach I had for a few years, was a guy named Louis Schiff out of New York, and he was from the Inc. 5000. And Louis wrote the book Business Brilliant and several other books. Actually pretty famous guy in the Inc. 5000. And just so you know, that's the top 5,000 non-publicly traded companies, right? And he used to coach me and other CEOs, and one of the things, he would ask the same question. I was like, what am I paying this guy all this money for? He's asking me the same thing every time I meet him. And it really came down to one question, which was, what are you going to leverage in the next 12 months to really catapult your business or catapult your life or change your situation? And it gets you thinking about leverage. What can you leverage? Can you leverage education? Can you leverage a JV partner? Can you leverage capital? Can you leverage human capital? You know, all kinds of things, right? So, you know, you hear a lot of these things from the Grant Cardones of the world, right? 10X, right? How do you, you know, really leverage things? What's holding you back? What's that obstacle? What's stopping you from taking things to another level? So it gets you thinking. And then the other piece is strategy. Strategy, you know, a lot of my coaches, I don't know if anybody else in here has coaches. I've had coaches for several years now. And a lot of the coaches will say, strategy is only good for 12 to 18 months. You need to change your strategy, right? So a lot of us don't. We get kind of pigeonholed into these areas where we do the same thing we always did because that's what we always do. We're creatures of habit sometimes. And we don't think about changing strategies, yet you'll see, especially lately, you hear a lot of talk about changing economic cycles and real estate cycles, and a lot of us don't adapt. But a lot of it's about finding leverage. We, like Tony Robbins says, we don't lack resources, we lack resourcefulness, right? So what was your first note? Anyone? What was your first note? Mine was actually my student loan. Let's see if I can remember what it was. So you'll like this student loan. It was, you want to guess? Well, first of all, does everybody know what a note is? Right? Like my wife says, it's a musical symbol, of course. It wasn't that long ago I thought a loan meant to be all by myself, right? But the truth is, it's a promise to pay. And usually when I'm talking about notes, I'm talking about real estate-backed notes, primarily 1 to 4 family residential. There's all different types of notes. I'll get into that a little bit. I have a saying that we're all in the note business, right? We all have student loans, auto loans, all those types of things. But my first note was my student loan. It was $5,800. I'm dating myself. It was 6.12% for 10 years. My payment was $65 a month. And I was bitching about that back then. I didn't pay it off till I was 32. So it's just like my kids always tell me, Dad, things were much easier when you were growing up. I was like, did you know me then? Because it didn't seem that easy, right? But later on, I often show a case study of how I paid for my son's college with about a quarter to a third of the money. So if anybody's dealing with college, remind me, I'll try to cover that story, because we would all like to pay for college for a fraction of the money, right? So opportunity. Before I get too far into it, I'd like to tell a quick story about opportunity. When I was 8 years old, my dad left my mom with 6 kids. So my mom was a single parent. Any single parents out there? You can relate. But a single parent with 6 kids is a little rough. So when I was in the like 4th grade, a lot of my friends were home in bed, asleep, and I was up at 4:45 in the morning delivering the Philadelphia Inquirer, right? That's a newspaper for any millennials that are here. Newspapers are almost gone, right? So, but I didn't mind doing it. I was helping mom out. I was, get a little bit extra money, able to buy clothes, pay for school books, things like that. And so my mom came to me with a unique opportunity when I was in the 8th grade. I had pretty decent grades, and she says to me, I want you to take this entrance exam to a college preparatory school in Delaware. And I grew up in Delaware County, just so you guys know. And that might as well have been Mars, right? Because I'm in my own neighborhood with the boys in the hood and all that, right? Like, I'm ready to go to school, and I don't want to go to Delaware. It might as well be a million miles away. So she kind of tricked me or conned me or whatever you want to call it. She's like, oh, don't worry. You won't do that. You won't do that well. Just take the test, right? So you kind of know where this is going. I take the test. I get a 4-year academic scholarship. And next thing you know, I'm wearing suits, and I'm with a lot of rich folks. And but it just shows you the power of the sphere of influence and how it changes your world. And I was totally blessed. Next thing you know, I'm in classes with 8 students, I had 3 hours of homework every day. It was just a lot different than what I was used to. And but you can tell it changed, because when I think all of us encounter these opportunities. I call it somewhat luck, and sometimes you make your own luck. But it's like, if you're not, who is it? Joel Osteen, the preacher. Are you ready to receive it today, right? If that opportunity comes by and you're not ready to receive it, what happens? It just keeps going, right? Well, that was that way with the note business. If I hadn't been ready for the note business, it wouldn't have happened, right? Or I'm sure you all encounter these types of opportunities where you go down the road and you hit the fork in the road, and what could be different? Now, me, obviously today, it's much different, right? A lot of things happened. I was the only sibling that completed college. Not that college is everything these days, but it was dramatically different. I had a different outcome than a lot of folks immediately to me, right? So I think it is powerful, and that, you got to be aware of these opportunities, be able to take advantage of them. So who am I? I was you. I joined DIG 2003. I was looking for capital. But when I first got out of school, I couldn't get a job in my field. Imagine that, going to college and can't get a job. But I was, I went into construction. I was doing that through college. Was in construction 20-something years. I tell a lot of this story in the book, so you can kind of go through there. But by the time I got to DIG, I had already had probably a dozen properties, something like that. And but today I'm a fund manager. I manage several mortgage investment funds. We have over 100 million under management. I have 31 employees in that business. I do have a couple other businesses. I'm a real estate investor still. I still have 18 properties. I did have 40. I'm also a note investor, so I have a private note fund as well. I wish I could say these are my kids. They're not. They're my grandkids. That's the sad part. And I actually have a 4th one now, a couple months old. So I'm a dad, a grandpop, all that good stuff. They're a lot of fun. So OPM, other people's money. So now, what was my second note? What was your second note? Anybody? Mine was a student loan. My second note was a credit card. And it was a Sears credit card. Why was Sears credit card a good credit card? It was the only one I could get out of college. Nobody else would give me one. But the other side was I could get my car fixed, right? I had to get to work. My battery went or something. But really, the real game-changing thing for credit cards for me was the first use of other people's money, especially after college. I was an accounting major. Any accountants in the room? I was an accounting major for 3 years. We'll rip on you later. No, I'm only kidding. I didn't really like accounting. I switched to, I got to watch what I say, right? Your wife's an accountant. And I switched to management my senior year. And but looking back, it helped me today. I do a lot of oversight of managing accounting and money and banking and thinking like the bank. So I had a lot of courses like that. So you don't realize till later in life that you do use it. And but back to the other people's money, I was taking a broker's course to get my broker's license in real estate. And one of the courses I was taking was real estate investment. And the first night of the class, we're all sitting there like tonight. And the teacher says, how many people in here have credit cards? Everybody raised their hand. He's like, how many people are buying houses with credit cards? And all the hands went down. And he walks over, he takes the course book, and he goes over to the trash can, and he throws it in the trash. And he goes, we won't be needing that tonight. And I was like, whoa. So I go home that night. I remember telling my wife, I was like, yeah, I'm thinking about buying houses with credit cards. And she's looking at me like I'm crazy. And she's going, well, that's not going to affect my ability to go to the mall, is it? I'm like, no, we're going to buy houses with them. And it was a different world back then, just so you know. I'm not recommending doing that today because there's a lot of cash advance fees. But back then, there wasn't. It was almost like free money to us. And because I was a contractor and I was a realtor, I knew how to fix things. I knew how to find deals. I didn't have capital, right? So all of a sudden, I fixed my capital problem. So I write myself a credit card check, drop it in the bank, pay cash for a house, fix up the house with another credit card, of course. Move a tenant in, refinance the property, pay the credit cards off. And then I accumulated a lot of properties that way. And then, one thing led to another. Next thing you know, prices jumped up. I had a lot of equity. I'm going to talk a little bit about that. And I became a lender. And at one point, I had 11 lines of credit, and I had about 400,000 of credit cards. I could go buy anything I wanted at that point in time back in the day, right? So you got to realize I bought my first property in 1989. I was in real estate since 1986. So we're going back a little bit, right? So. Purposeful planning. Now, a lot of this, what I'm going to touch on, doesn't mean you should do it. I like the disclaimers. That's good because I don't really give any advice. This is really just stuff I did. And a lot of times I didn't even realize I was doing it. So don't, oh, well, Dave said you got to do it this way and there's no other way. Don't take it like that at all. I'm very open-minded, actually. But before I get too far into it, saving taxes was one of the biggest things that I was able to do, that I was able to catapult ahead of a lot of people, like in my family. I had brother-in-laws that made a lot more money than I did. Yet I became ultra wealthy and they didn't. So what was different? And when I look back and think about it, a lot of it was these strategies. One was taxes. So does anybody remember Dr. Albert Ayala? Used to come to the DIG meetings a long time ago. Used to be on the DIG cruises. He taught a course on real estate taxation. It was phenomenal, right? So I took all his stuff. And really what you learned is there's a lot of strategies. Because every dollar you save in tax is another dollar you can invest, right? It's that simple. And then, of course, you have all the stuff you guys already know. Hey, I can use qualified plans, IRA accounts, self-directed, 1031 exchanges. There's all kinds of tax strategies. My thing to you is do it, right? One of the biggest things I do today, I'm still an agent. I'm probably a terrible agent right now. I'm a good CEO, I think, but I'm a terrible agent. But why am I still an agent? Unlimited passive losses, right? I can have a lot of earned income over here. I can have a lot of depreciation over here. It offsets each other. And then you have more money to invest. One of the things I noticed over the years was, you have this portfolio of buy and hold property. Really, the only difference between me and you, if we're the same age and I have properties and you don't, and we had the same job, is that all the money you paid in taxes, I put into this portfolio. Because really, those buy and holds are just carrying themselves barely, right? So it's for most of us, right? But investing intentionally is a concept I think a lot of people miss, and especially with their primary residences. So how many people were Mr. Accountant back there? A lot of people will go through life. I sold real estate a long time, owned a title company, sold insurance, did a lot of different jobs, right? But one of the things I noticed from financial planning and selling real estate is you see people's lifespans. You see when they start out and get married, right, Deb? You see when they're getting divorced. You see what happens when they're retiring and they're going to nursing homes, all the above, right? You see the whole enchilada, right? And you're like, well, what do most people do? So they buy a house, they sell it, they buy another house, they sell it, they buy another house. They might sell that, get another house. And then what happens if they're doing well? The accountant's telling them, hey, you need a duplex or a beach house, right? You need write-offs. Didn't they already have them? Didn't they already have a condo or a townhouse or twin before they had the big single and the bigger single in the hill, right? And isn't that kind of weird? But what happens is they go to the realtor, like me, and I tell them, you can't afford 2 mortgages. You need to sell that house and buy another one. But in reality, what if they waited an extra year, saved up the extra money, and kept it as a rental? If you just did that one thing, like I did, you'll double the value of your net worth in that bucket, right? But a lot of us aren't taught that, or we don't think that way. But it's really about knowing your exit before you buy. So what if you bought your first property where the rent would be higher than your mortgage, and you decided to keep it when you first got married, right? Life's different. You didn't buy as much house as you could every time. You bought, strategically. That's what I'm getting at. It would dramatically make a big difference. Another concept along the same idea is, I have a builder buddy of mine, this guy, Tim. Here's another way to think about buying strategically. He bought like a 13-lot subdivision. He built the sample house. He furnished the sample house. And then what do you think he did? He moved in it. He finished building out the other 12 lots. And what do you think happened? He sold the house that he lived in with his wife. What happens to that gain? He gets to put it in his pocket, tax-free, right? Because he lived there 2 of the last 5 years. That's investing intentionally, right? He strategically did it. He wrote off all the furnishings. He wrote off, right? Because it was the sample house. Well, this was a sample house for a new construction site, so it's a little different, but I understand what you mean. Sometimes it doesn't always work your way, but you can try, right? If you know your exit before you invest. How many of us do that with all the real estate we have? We might do it with our rental properties, but do we do it with the houses we live in? That's all I'm saying. It's just another way to look at it.
When you ask your question, please grab a microphone. Your apology is not accepted.
Yeah, there you go.
Thank you.
So accumulation mode versus preservation mode. This is something else you'll hear about this on Bigger Pockets or somewhere else where, most real estate investors are in accumulation mode, I would think. I know I was most of my life. And, well, that can be a problem too. I was at a dig event one night and a guy's talking. He owns 125 houses. He's like, is there any questions? And I raised my hand. I said, yeah, what's your end game? And I was like, crickets. He didn't have an end game. This guy's like 70, right? And I wouldn't let him off the hook. I said, no, seriously, what's your end game? And he's like, I guess I'm just going to leave them all to my daughter. I'm thinking to myself, that's great. Did you tell her? I mean, she might not want them, right? Like, don't be careful what you assume, right? I was going to say, would you hate your daughter maybe? I don't know. You leave her 125 properties. Is that what she really wants? And maybe she does. Maybe she's in the business. But you see the problem with that. A lot of real estate investors get tunnel vision. I'm just investing because that's all I've ever done, right? I never thought of my exit, which is not really a way you want to go, right? Now, preservation mode is a little different. I kind of did both. So I believed in accelerated pay down of debt. Now, there's a lot of ways to do that. Everything from sending extra principal to biweekly mortgages or whatever. Most of them today aren't as effective. The most effective thing I saw was sweep accounts. I don't know if you're familiar with those. I know George Antone teaches that. But a sweep account is where you're utilizing another account. You can pay off any debt in about a third of the time, 10, 12 years. You can pay off a 30-year mortgage in 10, 12 years. You could pay a student loan off. And a sweep account would be like, if I have a primary, $100,000 house, I have an $80,000 mortgage, I might take out a line of credit for $10,000, and the line of credit would be my sweep account. And I would use that as a checking account, drop my paycheck on it, and as I pay down the line of credit, write a check towards the first, pay down the first, and just accelerate the pay down. And what you're doing is you're utilizing your cash flow. That's basically what you're doing with a sweep account. So you're taking, what happens in most people's lives is they drop their paycheck in their checking account, and then they wait for their bills, right? They wait to pay their mortgage on the first or whatever that is. But in a 40-year period, your money sits idle for 30 years. Well, who's using your money for those 30 years? The bank, right? We always look at what's the interest rate on my savings, what's the interest rate on the loans I borrow. Nobody looks at the opportunity cost of the money sitting idle, which is fascinating to me. It's typical money and banking 101, right? The bank's telling you to park your money, and what are they doing? They're moving your money. So that's all a sweep account does. It's a unique way to move your money by utilizing a second account. And you never have to make a payment on the HELOC because you drop your paycheck in it. You can't go below zero. But if you ever need money, you can write a HELOC check to yourself or to, a repair or whatever that is. But it's a way to accelerate the pay down. There's no reason you have a 30-year mortgage other than you're not using a sweep account. It's really that simple. So working your equity. This was something else that I did a lot. I did believe in leverage, good debt versus bad debt. Sometimes it's a little blurry today with what is good debt, what is bad debt. Is a truck bad debt? If it's for your business, maybe not, right? Is student loan bad debt? Used to be considered good debt. Is a student loan always good debt? We're going to talk about it can be bad debt if you got the wrong major, right? There's a lot more going on about that today, right? But I did believe in reserves. Many people would tell me, how many people, if you talk to friends or family and you said you're in the real estate rental business, they think that you're nuts? Or how many people have you talked to and said, real estate sucks, I would never do that? Why does someone say real estate sucks? It's because they don't have reserves. If 2 heaters and 3 roofs all go at once, what happens? Guess what? Real estate sucks if you don't have reserves, right? That's really what it is. So it's, I think you got to look at that. I was a firm believer in reserves, or at least access to capital. You need access to capital. I'm not saying you need $2 to $3 grand for every property. That might work on 10 properties, but what happens when you have 110 properties? I have a buddy in Memphis has 1,500 houses, right? So at some point that gets silly if you had 3,000 per house, but it's good to have access to capital. Just as important as asset protection through debt. Now, a real estate attorney taught me this, 25 years ago. She said, Dave, even if you pay your house off, utilize debt to protect the asset, right? So I'll give you an example. I had a house in Malvern. It was a $500,000 house. Let's say I only owe $100,000 on that house. Now I'm in the delinquent debt business, right? So nobody knows this more than me. Nobody knows bankruptcy. We have 30 law firms we work with. So I spend $2 million in foreclosure every year. So think about what happens if I get sick. I can't, gosh forbid I get sick. I'm out of work for 9 months. I go down to the bank. I have $400,000 in equity. And what's the bank going to tell me? You don't have a job. I can't give you any money, right? Who did I protect? The bank. So asset protection through debt is really critical. And the other sister to that is liquidity, right? You want to have liquidity. And I think a lot of us aren't taught about liquidity. We don't think about liquidity. We'll think about peace of mind and paying off debt. And I'm all about some of that. But it's also about having access to cash. And what I think happens is you're changing the game. When you pay down, if I have a $100,000 property for simplicity, and I owe $80,000, and I switch that out to where I only owe $10,000 on the first, but I got a line of credit for 70 grand. What just happened? There's a control switch that changed. Who's in control of that equity? I am. Who was in control of the first example? The bank. Big difference in control there. So it's really about liquidity and asset protection through debt. If that Malvern property that's worth $500,000 and I have combined first and second mortgage for 90%, I owe $450 against that $500,000 property. If somebody, I get in an accident, somebody wants to sue me, they look at the Chester County Courthouse and they go, oh, he owes $450 against that. It might stop there. I'm not saying it will, but it could, even if I have a zero balance on the line of credit, right? So it could be a $350,000 line of credit and I don't owe anything on it, right? So it's powerful. Use of asset protection through debt and liquidity is critical.
So the bank, if you haven't drawn down on your line of credit, the bank at any time can cancel your line of credit.
It can happen. I mean, it doesn't always happen. I've had lines of credit for years and years. It can happen, especially with like business lines of credit, especially like PNC was like that. They would want to see your tax returns every year, right, Mr. Accountant? Like you have to go back and proof up again. That's the downside with those types of business lines of credit, especially. I only like those if I was using, materials for renovation, because that would make sense to me. It was short-term debt. So be aware of that. There is a risk of how I do this today. So I'll give you an example. My plumber. My plumber was a great guy. He had like $1 million house. He lived there with his wife and 2 daughters. And he buys a house in Marcus Hook, of all places. Anybody know where Marcus Hook is? But it was a rental property, right? So he's fixing it up. He took a line of credit on his primary, and he was buying the house in Marcus Hook, and he's fixing it up. So guess what happens to my buddy I went to high school with and all? My plumber. Took a heart attack. He was out of work, literally over 9 months. And he wasn't allowed to do anything physical anymore. Now he installs these little things on heaters for Pico, right? He just walks around doesn't do anything heavy. So he almost lost his primary residence. Why? Because he's a cheap real estate investor like the rest of us. He's saving interest rate, which is dumb. Why? Because it's short-term money. If he had went to private money lender or hard money lender, even though it was a higher rate, would he have risked his primary residence? Probably not. He would have just given the house back to Stonehenge Funding or whatever. Jim Bennett, I'm sick. Can you take the property and finish it for me? Whatever. They would have worked it out. Is a bank going to work that out with you? No, they're going to take the $1 million house in Glen Mills, right? So that's a problem. That taught me a lesson. And you know what the lesson was? Don't use that type of capital for that type of thing. So a lot of lines of credit can fluctuate in rate and all. So one of the things I started to do was, I'm not going to do that anymore. I had like 11 lines of credit against my portfolio of rental properties. I do believe in using your equity, because what's the rate of return of the equity in your house? 0, right? And when you get to, I was fortunate. My properties jumped up in value. Next thing you know, I had $2-3 million in equity. Well, could you see if I didn't use the equity? If I tap into the equity and the bank says, I'll give you 80% of that, and it's $2 million, that means I can borrow $1.6 million, right? If I borrowed at 4% on lines of credit and I lend it out to you guys for 14, I just made it 10-point spread. It's $160,000 a year. That's more than a lot of people make, right? It's not the end of the world, but it's good money. And it's passive, right? So can you imagine in Delaware County, where I was from, you could buy a house cash for $160. I could buy a house every year just by using my equity. But how many people don't use their equity?
So Dave, sorry,
yeah.
I'm going to ask another follow-up question. I may not understand this. If you take a line of credit out on your house and don't draw down on the line of credit, does that, let's say you take a $100,000 line of credit, does that $100,000 get recorded at the courthouse?
Yes.
So as far as the world is concerned, when they look at your recorded record,
yes,
there's a $100,000 debt against your mortgage, against your property.
Correct. That's the point of asset protection.
Okay, debt. So whether you've drawn money down on it or not,
it shows as the full debt.
Okay, that explains what. Use your microphone.
Right.
Use the microphone.
It's the same thing.
Yeah. Okay.
So, back to the plumber story, what I realized quickly was, hey, if I use my line of credit for its short-term rates that can fluctuate, what if I use it on short-term hard money deals or notes? Notes are very liquid. And if I go to do a rehab project, I come to you and borrow money. Well, what's the advantage of that? I'm building wealth twice as fast, guys. All my money's working. It's short-term money. Here's the other thing. If I'm paying him a higher rate, aren't I going to get the project done? I was a painting contractor for 20-something years. My oldest son still does that, right? What would we do when we had cheap money, like 4%? We're like, oh, we'll get to that property whenever. We're busy over here. It forces you to get over there. If I'm paying you 14, 15%, I better get it done. But if I'm making money on my lines of credit anyway, and it's more liquid, that might be smarter, right, than what my plumber did. And my plumber didn't do anything that I didn't do. I did the same thing up until that point. And I'm sure people in here are doing it. They're using their lines of credit. Or, is it the best use of your line of credit? You might be able to build wealth twice as fast. So some creative note strategies. Obviously, lending private money. Most of you should be familiar with that. You can find out about that at any meeting. I'm not going to go into that heavy. Just do it right. Just get the right paperwork, documents, know your borrower, know the property, get title, all the basics, right? Seller financing. Does anybody in here do seller financing? That's the Donna Bauer stuff, all that. Which is one of the ways I started in the business too. I was holding second mortgages when I'd sell a property. I would offer, try to get owner financing out of a seller. Does anybody buy properties with owner financing? Somebody giving you owner financing? I know there was somebody in Bucks County who was doing a ton of it. I forget the guy's name. Yeah, there you go. Multiple offers on real estate. So a lot of creative financing and notes enable you to do that. So by that, I mean, I got to a point where I never made one offer on the property. I would make 2 or 3 offers on the same property. Does everybody do that? You should, right? You should make at least 3 or 4 offers on the same houses. Why? So it's like, well, here's my offer if we pay cash. Here's my offer with owner financing. Here's my offer if you hold a second. Here's my offer if I take over subject to. Here's my offer. Now, I'm not going to blow their minds with 20 offers. I'm going to listen, find out their problem, just like all you guys do, and then craft a solution and give them maybe 3 offers, but that fit their deal. I don't want to blow their minds, but you get the idea. Always make multiple offers on your property. So tonight, I'm going to cover a little bit different topic. You know, I switch it up when I go out. I'm going to touch on lease options and subject to a little bit. So does everybody know what a lease option is? It's rent to own, right? What I like about it is it's a cheap way to get a property. And it's not a lot of capital out of your pocket. So if you're just starting out, sometimes lease options are the thing to do. I used to have my youngest son, when he was in high school, he would find me leads in the newspaper and call these people and like set me appointments, and I would pay him like $25 for the appointments and stuff. Don't tell him I ripped them off, but you get the idea. It was fun back then, get them into business. So this particular lease option was a property in Trainer, and I had actually sold this. It was just a twin. I sold it to a buddy of mine, and he bought it, fixed it up, rented it out. He was a newer investor, and guess what happened? The tenant trashed his place in a year. It was great. Now I'm like, and of course he fixes it up again, puts it on the market, and guess what happens now? It won't sell. And guess who the knight in shining armor was? Hey, of course. I'll take that off your hands. So I did a sandwich lease option with the seller, and it was, you know, he's a friend of mine. It was a neat deal. In this particular case, rent was $700 a month. I gave him a deposit of $1,000. Now I've seen people give deposits of $10. I mean, this guy was a buddy. I was going to let him off the hook. But I managed a lot of property back then. I was a property manager at a Remax back then, and managed quite a few properties. And I had somebody moving out of an apartment building. I go, I got the house for you, right down the road. And so I actually did a sandwich lease option. So in this particular case with the seller, I knew his mortgage was just under $700 a month. I took over his payment. With my rent, the sale price was $75. He was originally asking like $89. I said, oh, if you had to knock out the commission, right, Deb, and a couple other things. Oh, and there, you know, you don't have to worry about this and that. So I did a 5-year lease option, and anything over $300 he would take care of. And you kind of know where the rest is going. Has anybody seen Wendy Patton or any of those? You know, she's great. I mean, if you're going to do this. And in this particular case, with the tenant buyer, you can see I was getting $950 a month, $3,000 deposit. So I put $2,000 in my pocket. I'm making $250 a month. And guess what the neat part is? How much repairs am I doing? 0. So why do we want to own property again? Oh, yeah, because we were told we should own it all. This is about control right here, right? You don't have to own it. This was a 2-year rent to own. And the reality is they never exercised it. I actually gave the property back after 5 years because the market tanked. It's like, nah, I can't exercise it. Right? So, but it does usually work. What else can you do on the repair side to kind of get you out of the repair business? Home warranty, right? Put a home warranty on it. Home warranty might be $400 a year, $500 a year. You put in the lease that the tenant does the first $100 or whatever that home warranty thing is. And guess who goes out to fix anything? It'll cover anything but a roof, right? So usually, or unless you have a swimming pool or something. I don't like houses with pools for rentals. Anyhow, you get the idea. So how do you know, I was going to touch on lease options versus subject to. Anybody in here do subject to deals besides me? Nice. Like it. Subject to works a little better in this market, doesn't it? Doesn't work that well in a down market. Trust me. But how do you know when to do a subject to versus a lease option? Oh, shoot. Does everybody know what subject to is? It's a clause, right? That's all it really is. It's a clause in your agreement of sale. How many times you put a clause in subject to inspection by my partner? Come on, that's your favorite, isn't it? So why can't you put subject to me taking over your mortgage? Now, a lot of you might be thinking, why would somebody do that? Obviously, they're a distressed homeowner usually. How do you know when to do, I'm coming back to my first question, how do you know when to do a subject to versus a lease option and what's appropriate when? You're probably a good person to ask that too, but you'll have to get mic'd up, so I'm going to save you that. It's really that if a property needs a lot of repairs, I'm not doing a lease option, right? If I'm putting a lot of repairs into a property, I need a deed. It's that simple, right? So just make sure you're not doing the opposite. I've seen people do that mistake, right? So this was a subject to deal in Chichester, not a bad little house. This wasn't my subject to. I was the realtor in this deal. I have done literally hundreds of subject to, and how can I say that? Because I do them from a different angle. We buy a lot of delinquent mortgages. We buy a lot of second mortgages as well. We buy primarily first today, but when you own a second mortgage and you foreclose at the sheriff's sale, guess what happens? I get the sheriff's deed and it's subject to the first mortgage. So I've literally done hundreds and hundreds and hundreds of subject to deals, but not in the traditional sense of how you're doing them, like in this deal in Chichester, right? I was the realtor on this deal. So when we first went to this house, it was a house that looked like the hoarders lived in it. It was a train wreck. And what does the typical realtor say, Deb? I don't want to list this pig. I want something that'll sell quick so I can go to the beach. So, but I had a buddy, Tom, who had done some subject to deals. And I told the seller, hey, why don't I introduce you to my buddy? And what did my buddy do? He let me list the fixed up property, all pretty. I made a lot more commission, sold very quickly. So in this particular deal, this was a guy who wanted to move to Delaware, be with his daughter. He was at retirement age. The house was a train wreck. He was behind like 2 months or 3 months. So my buddy Tom comes in, takes over the mortgage, brings it current. And I'm going to talk about some of the advantages. He actually picked this up for $145 and obviously worth $2.25, needed some work. But you can see the advantage of doing that. Now, at the time, this interest rate appears high today. This is an older story. This was a low interest rate back then. So you got to take that with a grain of salt. But so for the buyer, no qualifying, right? It's pretty cool. You like getting a mortgage where you don't have to qualify? Yeah. Low closing costs, just like cash, right? Subject to, it's just like buying a cash. You're probably going to pull title, but other than that, you might have transfer tax or something. Better terms sometimes. Why is it better terms? Better than hard money, right? I don't want to go to Jim Bennett. I can go to here. Why should I pay 14, 15% to Dave Van Horn when I can take over someone's mortgage? What else is cool about that? Sometimes you're further in the amortization schedule, and most of the P&I payment is more principal than interest. Does everybody follow that? So if this guy lived there like 15 years, and now my buddy Tom takes over, it's pretty cool, right? A lot cheaper than hard money, right? A lot less fees than a regular mortgage. So you could see it could be better terms, right? Better terms than hard money. How about for the seller? You can move immediately, right? No cleaning or repairs, no inspections. Now, a lot of people are like, who would let somebody take over their mortgage? You got to be crazy, right? But why would they? Isn't it easier today to track, though? You got online banking. I mean, it's pretty easy today to tell, hey, are they going to pay my mortgage and that kind of thing, right? You should do the right thing. You should pay their mortgage, right? You don't want to make their credit worse than it is. It actually improves his credit. So when my buddy Tom brought this guy's house current, what did it just do? It improved his credit. When he started making payments, it improved his credit, right? There you go. I knew I wrote it somewhere. What are the pitfalls? Existing liens, right? That's why you want to check title, right? Because what if this old guy had other liens, mechanics liens, or who knows what, right? Dual and sale clause, what's the deal with that? Isn't that what everybody panics about? has anybody in here had the due on sale clause exercised in a subject to deal? So remember I said I did hundreds of them? Guess how many we had in the last 12 years? It was hundreds of them. We had one time, and it was because they were deceased, and the first figured that out. So it's extremely rare that they would call it. I had another friend, actually local gal, Victoria, she's an attorney. She had a deal in Lansdowne, not Lansdale, I know where you guys are from, Lansdowne, and she brought it subject to, she owned it for several years, and what happened was the first was sold to a non-bank holder of the first mortgage, and they saw that the deed had transferred, and they called her loan. Now, she had access to reserves, and she took it out, refinanced, that type of thing. So it doesn't mean you don't have to have money. You just have to be able to get access to money, and you can literally take over a property with very little money. What about the insurance on a subject to deal? It's always tricky, right? Does anybody know Tim Norris from Infinity? He'll do insurance anywhere in the U.S. We give him a whole list of properties. Here, insure these. You can insure the note, too. So what do you do with vacant lots in Detroit? How do you insure that, right? You can get a policy for $8 a month on this. So a lot of people don't know that exists, right? Or how easy it is. But Affinity will... So I check with my buddy Tim. I go, it's subject to, what's the real deal? What do you do with insurance? What do you think he said? Whoever has the deed needs to be named. They don't care about... Now, there's some... I don't want to say tricks. I don't like the word tricks. There's some better ways to do it, right? Be named insured along with the original homeowner, right? You can both be named, right? There's nothing wrong with that. Just be added. Just do an endorsement to the policy. It's the easiest way. Does the bank pick up that someone was at it? No, not really. As long as they see the original borrower, they're not going to think it was transferred. They're not going to know. How would they know? Unless they do some kind of search. And you know how fragmented mortgage companies are. They're pretty fragmented, right? So just be named insured. If you take over the deed, can you write it off? Mr. Accountant. Yeah, if you're paying the mortgage, your house, you have the deed, you can write it off, right? A little harder to document everything, but you get the idea. Institutional notes. So how did I get into institutional notes? By accident, of course. That's how everybody gets into something like that. Actually, I was running a little real estate meeting, sort of like this, and I used to get speakers, like Don did tonight. And I had a speaker out of New York who was raising money for pools and mortgages. And of course, what do you think I did? Nothing for 3 years. And then right before the downturn in 2007, we reached out to him, me and my partner, a buddy of mine. We said, hey, show us how to collect on distressed debt and we'll buy assets from you. And the rest is kind of history. And we started out as investors and then like a club and then like a little business. And now we're like an enduring enterprise sort of, but you get the idea. We didn't start out that way. We started out as... So be careful when you do partnerships. Oh, is anybody in here partners with anybody? There you go. It's like a marriage. So what are some of the advantages of notes? Passive cash flow. Is real estate really passive? I don't know. When they call it the bed bugs, is it passive? Not my teasing. Anybody have bed bugs besides me? They're fun, aren't they? I think they breed them and bring them in the house. Anyway, volume and control, right? Banks figured this out a long time ago, right? Would a bank rather own 30 million mortgages or 30 million properties? That's easy. Profitable in various market conditions, right? There's ways to change your strategy and make money. I think one of the things that a lot of real estate investors miss on is that they think notes are illiquid, or that if I have a 30-year mortgage that I can't get recapitalized. And there's nothing further from the truth, because you can borrow against the note, you can sell the note, you can sell a piece of the note. That's all hogwash. I can sell a note in 15 minutes. I can't sell a house in 15 minutes, right? Not yet. You can go on eBay maybe, but you get the idea. Very liquid. Collateral-backed investment, right? So it's real estate. One of the things I liked about notes is anytime I could buy non-performing notes at a discount with a high yield with collateral, it became appealing to me. I used to trade options, and what I liked about notes was there was collateral. There's no collateral in the market. And even if I do a creative strategy like a butterfly trade where I do puts and calls combined or whatever, what happens when I do that? It reduces my yield as I put insurance on my trades, right? What I liked about notes was it's an asset-backed investment. What else is it? You're ahead of everybody. I'm not saying there's no competition when you're bidding, But how many people are in the We Buy Houses business like I was a few years back? You know, it's just different. Notes are kind of similar to that. It's, you know, you're sitting in someone's living room and, you know, the roaches are falling on the paperwork and the dog with the mange is licking your ankle and you go to leave and there's 3 more We Buy Houses folks coming up the walk. We don't have that in notes. I know you'll miss that. But, and it's not like going to the sheriff's sale. You don't have, you know, buying a house sight unseen. And you get the idea. You're in a competitive environment with an auction thing going on. It's probably one of the reasons I took Mark Sherby's course, which is very good, by the way. Why do you think I took it? I want to see how you all think at the other side of the aisle. Because the attorney at the sale is my attorney, right? Why do we bid them up so high? Because we want it back, right? Versatility. Anything you do with the house, you can do with the note. Like I was saying earlier, you can rehab the note, you can flip the note, you can borrow against the note. And socially conscious investing, right? So a lot of times you're able to help a lot of people that are in distress. So whether a property is occupied and you mod it and keep a family in their home, which is kind of rewarding, or you have a vacant first mortgage, for example, it's kind of socially, it's like community stabilization, right? Does anybody want a boarded up house next to them? I know I don't, right? Do you like the high grass and all that? No, right? You want to get that back into the tax rolls, right? So where do you find these things? Online sources. What are some online sources? Auction.com, Loan MLS. Do you guys, anybody in here buy notes already? Anybody in here do hard money, private money? Yeah, there you go. That's a note business, right? Note brokers. You know any note brokers? Colonial Funding, Mountain View Capital. You can go to a note broker and buy notes. Loan exchanges, FCI Exchange. You can go buy first mortgages rated FCI Exchange. Note funds, that's what PPR is. We're a note fund. There's plenty of us around. There's hundreds. You're just probably not used to looking for them. That's really what it is. Or it's just like a whole nother network, just like real estate is. And once you get in that network, it's really getting educated, getting in the network, and maybe finding someone to JV with, that type of thing. Banks and servicing companies sell notes. We buy a lot from there. We also buy from the GSEs, government agencies like HUD and Fannie, Freddie. Private sellers, we talked about that. Ways to get started. Performing notes is probably one of the easiest ways because it's not non-performing, right? It's getting paid, right? So you're collecting payments. One of the things we do at my company is we have warranties, right, Deb? If our loan redefaults, we'll buy it back, and our warranty is investment principal minus payments received. Now, if you have a portfolio, then it's a good way to manage risk, especially if you're not into collections and being licensed and all those things. Note funds are another way to passively invest in notes. There's some advantages to that, especially for like our funds are high net worth folks, but there's some note funds that aren't. They're open to everybody. And especially with crowdfunding, like AHP does one, you can invest as low as $100, right, in AHP. So there's plenty of note funds you can invest in. And what's nice about that is you have limited liability. Like you can't be sued. Their fund could be sued, but you're not going to be sued personally, which is kind of neat. And you have diversification. You're protected by a whole portfolio of notes. So if one note goes bad, it's not the end of the world, right? And you could be, you know, what's that saying? I always say, what's the biggest risk in the note business? And I say, it's you. Why do I say that? Because you don't have enough diversification of capital in the marketplace, right? So it's, if you have one note and it defaults, you have a 100% default rate, right? If you have 10 notes and one defaults, you have a 10% default rate. You see where I'm going with that, right? So if you have 1,000 notes and one defaults, it's totally different, right? So keep that in mind. Non-performing notes, not for the faint of heart, not against you doing it. Just be careful if you do, right? That's all. But if you're buying vacant first, you're getting the property most of the time. What do you think the ratios are for us when we're buying first, typically? If you bought 100 first mortgages, probably 40 of them are vacant, roughly. 60 of them might be occupied. And by the time you get to foreclosure, half of them become vacant. So you're going to have to be around 70% where you're getting the property a lot of times. Seller financing. That's how I got started in notes. I have a note right now in St. David's near Villanova. I sold that house 15 years ago. I'm still getting payments. Nothing like getting payments on an asset you used to own. Private or hard money. I still do some of this. Today, we do it as a business too, more strategically. A lot of times we have boots on the ground in locations. Like I have a gentleman in Florida that manages 3 counties for us. He does 500 flips a year, one guy, one outfit, right? So you see the power of that. But we can feed him assets, and he'll look at assets before we put our bids in. We'll have a seller before we buy the asset. So a lot of times we'll fund them. We'll fund the hard money or the hard money line of credit for these folks. And assets off our books at a higher rate, right? Why not finance them for a capital fund, right? Oh, forgot this last one. Peer-to-peer, P2P. Does anybody do Prosper.com, Lending Club, all those types of things? It's the note business, right? A lot of the young folks in our office, especially in analytics, they used to play around a lot with Lending Club. Why? Because they had the analytics. Now, the cool part about some of that stuff is you can invest as low as $25, and a lot of the young kids in our office didn't have a lot of money, right? So, but Lending Club they could do, right? They could pull that off. So peer-to-peer lending, so it doesn't take a lot of money to get started in notes, right? You just got to get started and figure it out. Receivables. What's a receivable? So anybody in here an HVAC guy? So I'm out to lunch with my HVAC guy, and I said, you know, they're worth like brain surgeons today. Does everybody know that? HVAC guy kills you. But anyhow, I'm out to lunch with this guy, and I said, hey, did you ever thought of financing the units? And what do you think he says? Oh, there's a company that does that. I go, I know. Did you ever think of doing that? Oh, you can do that? Yeah. Would it pay him to do that? Yeah. Because if he gets a deposit and it covers the cost of the unit, who cares if he finances the labor? How sweet is that? Because why? Where's the value come in their business? It's from the service contracts. The more heaters he installs, the more service contracts he has. When he goes to sell the business or value the business, it's all based on service contracts. Not so much as many heaters he installs, right? Why not make it easier? Why not finance it? Do you think your IRA could own that company? Yeah. So I run a fund out of Dallas, and I run one in San Diego. The one I run in Dallas is all physicians and doctors, dentists, that kind of thing. I've been running it a while. And so I was out to lunch with a dentist and his father down in Dallas about, 6 years ago. And what do you think I said to him? Have you ever thought about financing dental work? What do you think he said? There's a company that does that. I'm like, I know, you idiot. No, I'm like, so I said, same thing. And guess what he did? So he goes back. He has an orthodontist buddy. They form a company. They use their IRA accounts. So I saw the guy about a year ago. And what do you think he said to me? He goes, you're not going to believe this, but the finance company is worth more than my dental practice in 5-6 years. How was that possible? Well, think about the group we were in. There's like 150 dentists in this group. He started doing the financing for all his dentist buddies. So it took off like a rocket ship. So a lot of times people go, oh, where do I find a note? They're right in front of you. You just don't see them. They're all around. Commercial notes. Anybody heard of, locally, I think a CS2000. Bill Bromley used to be president of a bank. He merged banks. He formed banks. He retired. Started a company called CS2000s. They're local. There's many banks. These are merchant accounts. So I don't know if you ever heard of companies that lend on receivables. So you could be a restaurant. Basically, they go in and grab daily receipts to get paid back. And it's like hard money rates. Now, you're tied to the receivables of a company. It's different collateral than real estate, but it is the note business. It's a commercial note on your receivables to your business. Why does that business exist? Because banks will only lend to businesses that own real estate. If you don't own real estate, they don't want to lend to you. So, of course, the smart retired banker figured that out very quickly and said, hey, I'll take an opportunity at that. And they know the default rate. There is a little bit of a default rate, but they measure that. It's just like any other data. So commercial notes, they pay 14, 18% returns, real high returns. It's like hard money. So notes paying liabilities. Don't worry, I'm winding down. We'll be opening up to some questions. So I had a buddy of mine. He was putting an addition on his house in Springfield. So he says, I'm putting an addition on my house. I said, well, why don't you try borrowing some extra money and buy a note? I go, oh, yeah. I go, why not get a free addition? So he got the estimate for the addition. He takes the equity loan for the addition. So he borrows extra money. He buys a performing note. Performing note pays the payment on the addition. Free addition. Would you rather have a free addition or you rather pay for it yourself? Right? Most people pay for it themselves. They don't think of leverage or a strategy. Free or low cost life insurance. Any insurance agents in the room? Does your insurance agent show you how to get free insurance? I'd fire that SOB. No, I'm kidding. So anyhow, a lot of my high net worth clients, they don't pay for their insurance or they pay very low for their insurance. And here's what they do. Wealthy people use insurance completely different than blue collar folks, right? And a lot of times people are using it for death benefit or loss of income, whereas wealthy people use insurance policy as banks. They can be just as valuable as IRA accounts, actually more valuable. Because what do you think family office type folks do? Do you think an IRA helps them? No, you can only sock away so much into an IRA. Even with a defined benefit plan, you're kind of capped at some point if you're super wealthy, right? So a lot of them will use policies, right? So I learned this when I was like 19. I worked for a builder in Chester County. And what do you think the builder was doing? He would borrow money out of his life insurance, build a house, flip the house, make $7,500 per house, pay back the policy. Do you think the insurance got cheap after a while? Hell yeah. So you can do that with notes too. You can do that with real estate as well, or hard money. So you can overfund your policy. Now keep in mind, there's over 30 types of life insurance policies, and some are usually geared towards death benefit or cash value. You're looking for ones that you can accelerate cash value. Some policies, you have to wait 20 years or more before you can access the cash value. There are companies out there, and a lot of people don't know that, like Ohio National is a company. You can access money in 15 months. So you could really drop serious cash into a policy and get your hands on it relatively quickly. And then when you borrow the money out, it might only be 5%. But if I can go do hard money at 14 or 15, or I can go do a deal that makes more than that, you can see the arbitrage starts to pay my premium or lowers the cost of my insurance, right? Now, what also happens in a lot of those policies is you're getting paid you're getting a dividend based on the full amount, like you never borrowed it. And if I have $1 million policy and I borrowed out $100,000, what happens if I kick off? My heirs get $900,000. Well, I don't care, I'm dead. No, I'm kidding. No, I do care because they borrowed the money out and bought another asset. So are they behind the eight ball? No. So very important to utilize. I think a lot of business owners, a lot of real estate nerds like us, they don't sweep money off the table into safer buckets. And I'm a big proponent of that. IRA accounts, insurance policies, contracts, things like that. They always tend to put everything back into real estate. Well, real estate is like anything else, or a business cycle. It's like this, right? So you got to sweep money off the table once in a while, put it in safer buckets that you can get your hands on that are tax advantaged. There's a lot of advantages to these. Pass favorably to heirs. If I get sued, can they get my insurance policy? If I go bankrupt, can they get my insurance policy? Where'd my attorney go? Oh, there she is. If I get sued or go bankrupt, can they get their hands on my life insurance? Most of the time, no. There are some states, it depends on what state you're in. So I'm giving the politically correct answer. It depends. It's not just a diaper, it depends. But anyhow, so free or low cost insurance, it's something that's real, right? You can make it happen. College for a fraction. So I promised I'd tell you this quick story. It's not too quick, but so my son's ready to go to college, and he's like, are you going to just write a check? I'm like, you probably heard this story. So I said, no, that's not how we do it here. But I said, don't worry, I'll show you how to pay it back. So I go, you and your mom are going to take out a student loan. You like that, right? So my son takes out a student loan. Do we need to take out student loans? No. Could we have written a check? Oh, yeah. Is it really the best strategy? Maybe not, right? So what we did was we took out student loans whether we needed it or not. Why? Because my money's in investments is making a higher yield than the stupid student loan rate, right? So don't I want to keep my money invested? Why would I take my investments out to pay for junior's college, of all things? Now I'm a kid. But it does a couple things. So my son was a good kid and all, but do you think it's better if the kid has a vested interest in the cost of his education and he has skin in the game? I do. Did anybody go to college and sit around and smoke pot all day and not go to class? I see people laughing. Why are you guys looking at me? Anyhow, it happens, right? You went to class, right?
It was your pot.
You would have been better off just staying home. Deb, you could have saved yourself a lot of hassle. How many concerts did you miss because you went to class? No, but anyhow, but you get the idea, right? You want kids to have skin in the game. I think they get more out of it. They appreciate it more, all that kind of thing. Now, not everybody agrees with me. I get it. So anyhow, he takes out a student loan. It's in his name. It's his credit. He's got to get a job when he gets out. Can't sit on the couch playing video games, right? You got to go back, pay off that student loan, right? So my wife takes one as well. Now, hers is a little different because we did have to pay on it while he was going. His was kind of neat. You don't have to pay on it till they get out. And then they have a deferral period of like 6 months. So guess where Junior's working when he's done school? My company, because he can't get a job, right? But anyhow, he's working at my company and he's like, oh, I thought you were going to show me how to pay this thing back. I was like, yeah, how much you got saved up? So he had like $5,000-ish. And he owed about like 15, 17 grand, something like that. So we found him a note on a reperforming second mortgage that had a payment that was identical to his payment on his loan. It was close enough. It was like $300 a month. And so he bought a loan for a fraction of the money, and the payment from the note paid the payment on the student loan. So everybody follow that? And he actually had a couple extra years on the note. The note was like 12 years and the student loan was 10. So I kind of did the same thing with my wife's, right? Can you write off interest on student loans? Yeah, in a lot of cases you can. Right? So is that different? It is when you talk to his girlfriend's parents, because she went to the same college and they wrote the check. And my son's always telling her dad how he paid like a third of the money. That goes over real good because it was expensive. So the other side of that, here's how I know it stuck. So he gets done school. He's working for me. My son was a writer. He was an English major. And he was moving to LA. So he ships his car out there. And he actually went to work for Sir Ridley Scott. He was archiving film. So take him down to the Philly airport. And I give him an envelope with $5,000. And he's like, what's that for? I go, why don't you tell anybody your old man didn't pay for college? And he's like, oh, I hate you, right? So then he ships this used car out there. And he has the car for like a year or two. And of course, the car goes. So what do you think he says when he calls me up from LA? You got any short-term notes laying around? That's how I know it clicked. But how many 24-year-old, they don't think like that, right? So the cool part there was we ended up getting him a 7-year note. It was a short-term note. And what can you get? I go, how much you got saved up? And he had like $4,400, something like that. And I go, well, what are you going to buy with that? It's somebody else's headache, right? Used car. So he was actually, we got him a note, same type deal, short-term note, but it had like a payment of $290 or something. And he was able to lease a brand new Prius for the cost of a used car because he put it towards the note and the note paid the Prius. You follow that? Now, what's cool about that, it was a 7-year note. So you could lease for 3 years and then lease another one for 3 years. But he ended up moving to New York. But you get the idea. You could, and then still have another year of payments. That's pretty sweet, right? So most people don't operate in that mode, right? They go like this, and they pay for everything out of their pocket. They don't think about, how do I get my investment to pay for my liability, right? So it's a little different mindset, right? College for a fraction. So quick recap. Utilize OPM if you can and note strategies to accumulate assets. Accelerate debt pay down and utilize asset protection. Use HELOCs and insurance to leverage and protect your equity. This is a good one. A lot of people are like, yeah, I want 20 houses free and clear. I used to drink that Kool-Aid. Worked for a while, but you start to realize it's kind of, is it really relevant when you pay them off? Not really. I mean, if I have, say I have a $3 million real estate portfolio, and I don't know, I owe $1 million or I owe $2 million. Does it really matter when I pay that off? If I owe $2 million, I have $2 million in the bank. Does it matter? Not as much. If I have $2 million in life insurance that I buy for a song, does it matter as much? No, it matters even less. Is it better to pass properties after you die? Yeah. So why do we do it the other way? Oh, yeah, because I saw so, I don't know. I go back and forth in my mind, right? It makes you think, though, right? But I think people need to use note strategies and estate planning better when they're thinking about their exits of their investments or real estate. And I think they don't. They they saved money. I know my family did. I watched my grandma go in a nursing home, wipe out 5 estates because they saved $2,000 in lawyer fees. Right? You're laughing. That is literally what happened on my mom's side. How dumb is that? Well, it's smart. They saved $2,000. You got to be, you got to think it through, right? A lot of people don't. So keep that in mind. I mean, I know it's a lot. So some resources. We do have a Learn page and education. We do have, occasionally we have events. We have a Mid-Atlantic Summit that comes up. People want to know more about that. I know you were there last year. Trying to think what else. I also have a group that I run called Strategic Investor Alliance. I know, Don, you've been there. If you're a high net worth person, the way this group works, it is invite only. You do have to be an accredited investor, but the cool part about the group is that we only meet 5 times a year, but we share, it's similar to the family office concept where we share resources and we share alternative investments, and we also share advisors. So the group acts like Yelp for that. So, I kind of came up with that idea from the family office concept because they have 200 million under management. It's very easy for them to have a board of, investment advisors and all that type of thing. Whereas the smaller millionaires don't have that. And I like grouping them together, and now we have power, and then we can go get those kinds of things done. I know, Don, you've been to one of our meetings or two. So I did bring some books along for everybody. I will answer some questions till you guys throw me out, I guess. And anybody have a question?
We have plenty of time. Grab the mic, please.
When you're buying notes, knowing how many banks have come and gone, is that chain of custody a problem? Or no? Why not?
No, we're members of MERS, and there's ways to find out who owned what. It's not really, no. And even missing documents. There's document custodians. There's document retrieval companies. Now, I'm not saying you can fix everything. There's some things that are like a lost note's you can get a lost note affidavit. In some states, they don't really recognize those. But if you know what states they are, then you stay out of that state, that kind of thing. So, but there's ways to navigate most of that. Yep.
Dave, can you go through the layers of notes from their origination? Because I know, at the very beginning, the bank owns the property, right? And they sell the note to somebody who sells the note to somebody who sells the note to somebody. How many layers are there, and what's the markup, if you will, of each layer?
Well, you're saying a lot. So you're asking the question is, what's the life cycle of a note? And really, the bank doesn't own the property. You own it. You just have a debt, right? And the bank owns the debt, and the collateral is your property. And if you don't pay them, they're going to come take it from you, right? So when they originate the mortgage, what's interesting to me is that you could have a $100,000 mortgage sell for $105,000, $107,000, $103,000. Did you know that happens even? So they package up loans and they sell them at a premium. Why are they able to do that? It's based on credit risk. So if you have an 800 credit score, maybe that loan sells for 105 instead of 103, that kind of. So that boggles my mind a little bit. Why? Because in a 30-year amortization schedule, it's all front-end loaded with interest too. So I think it's like year 19 in most mortgages before you start to turn the corner of paying more, where you're paying more principal than interest. It's kind of interesting, right? But what's the average time somebody keeps a mortgage in the U.S.? All mortgages, 5 to 7 years, right? So what does the bank know? Is that like a fixed game, like the casino a little bit? Yeah, if I give you a 30-year amortization, it's front-end loaded with interest. The average person keeps it 5 to 7 years. Now you know I studied money and banking. All the money's in banking and oil, what it used to be. Not anymore. But you get the idea, right? It's a fixed game.
You didn't answer my question yet.
I didn't? Okay, so originate the loan. And there's a lot of origination shops, right? They get paid fees and they package up the loan, they securitize them, all that good stuff. So then they go to a bank or whatever, it could be FHA. And then if a loan defaults, what happens? Is that what you're asking? Or where does the loan go after it's performed?
Right.
It's originated and performing.
How many layers of people, how many layers of
how many people can own a loan? Oh, a lot.
No, how many layers of hands does it go through before one of us can get our hands on a note?
Oh, it could be quite a few.
What is the markup at each layer?
Well, it depends. If it's a delinquent loan, it could be selling at a discount. It depends. It depends on the type of bank. A lot of community banks and credit unions, they don't really sell. It really comes down to, there's top 16 banks in the U.S. that really handle the bulk of mortgages. It's really top 4 that handle like 75%, the Bank of Americas and Wells and stuff. But there's really 16 top ones, and there's probably 8 real top ones, and then there's 4 that really dominate. So most mortgages end up in that bucket.
So what
I don't know which part of this question you're asking.
well, I don't want to dominate the time, but what would you say? What does a bank sell a performing note for? Let's use performing as an example. Well, what cents on the dollar?
There's a lot of different semantics here. So there's performing, reperforming, scratch and dent. You'll hear all these different terms, and they all mean a little bit different things, right? So you can have a loan that was delinquent. Now it's reperforming. If it's reperforming for more than a year, it's really considered performing again, right? So you can see how it can evolve. And then a lot of times people will refer to one that pays 10 out of 12 months as a scratch and dent loan, or like a semi-performing loan, right? So there's different levels like that. But then there's, most loans perform. Very small percentage. I think the default rate now is like 1%. It's really low right now because they've been really strict on originating for the last several years, right? So it's a very low default rate right now. I don't know that I'm answering your question. I keep beating around it, I guess.
Yeah, okay.
Can someone clarify his question for me?
The question is, okay, I think this is the question, and I'm curious about this, is when you have a note that is originated by a traditional bank.
Yes.
Okay, that's going to sell that note, and it may get, I think this is your question, it's going to get sold and sold and sold. When does it get to the point where a normal, regular, hard money lender or private person can get to that note?
Anybody in this room.
Okay,
well,
that's I think the question
is what
he's
you're really
asking.
Well, it depends.
And then the second part of your question is, what's the markup when it gets there?
At each layer.
Right.
So if a bank sells a note, just use an example, at 40 cents on a dollar, who does it
They're
sell
not
to?
really selling that many.
Yeah, well, he's saying they may sell.
They're not even selling non-performing these days. If it's a first mortgage, a lot of them are trading pretty high right now because it's notes are in direct correlation to real estate values. So we're in more of an up real estate market, generally speaking. So you're going to pay more for notes right now.
70 cents on the dollar?
They can go that. They're even in the 80s sometimes.
Okay. So
Now, part of you might go, why would somebody pay 80 cents on the dollar for a first mortgage? Maybe it's in Brooklyn. I just did this. We had a deal where we paid like $350, property for 7 something. It's like, what do I care if it's 80 cents? So a lot of it.
You don't care if it's 80, but if you're selling it to
Well, a
somebody,
lot of times is it 80 cents on the current value, but what's the ARV, right? That's really what was happening there.
All right.
So on the current value, it was 80 cents, but why would I care? What's the worst that would happen to me there? They would start paying me. If they start paying me, that's where I lose money. But if I buy a pool of loans and the majority don't pay me, do I care that one did? No, not really.
So you buy it
Cost
for
of doing
80 cents
business.
on a dollar. What would you sell it to us for?
More. No, I'm like kidding.
Well, that's
No, but we don't
no,
buy
that's-
them all. I mean, it could be 50 cents, 60 cents. Well, here's what else happens. So first mortgages, for example, over 250,000 trade up, trade at a premium. Why? Because insurance companies, pension funds, they gobble up all those high-end first mortgage because they're safer, right? The collateral is tighter on that. They don't want low-end first. As you get really low, like you get under 50,000, the cheapest first I ever bought was probably 12 cents. So, I've bought $100,000 mortgages in Detroit for $80.
You see why?
And you say, well, Detroit's risky, but is $80 risky? Like, you got to put it in perspective, right?
So you see why this is confusing to some of
Yeah,
us.
we like it that way.
Chris, go ahead.
So if a bank originates a $100,000 note and they write that to the client and then immediately sell, they're selling off the future payment value, correct? So they're
Yeah.
not selling it for 80,000 the next week. They're selling it for maybe 120.
Well, they
because-
won't sell that much of a markup, but an 80,000 loan might sell for 82,000 or
Right.
something like that, right?
So they take a quick hit and
they
keep
take
it
a quick
moving.
hit. But you got to realize the bank's operating differently because they can borrow from the Fed and they can
Right.
they can lever up and they can, you know, get
But
7
it's
times their
sold-
money and 10 times
I
their
think
money.
that's
So it's a
kinda
different
what you were
ballgame.
getting at, like, he's asking, like, how does the bank sell that $100,000? Do they sell for
Well, they just want
80,000,
fees, right? They
70,000?
just want fees. They want to originate,
Right.
and they're just going to recycle the money and recycle the money and recycle
Right.
the money and sell them off and recycle the money.
Right,
That's,
so they might
it's all about
sell
moving money.
to Bank
and
B for
fees.
102, and Bank B might sell it for 105, and then keeps going until somebody says, hey, it's worth X, and buys it.
Yeah, I mean, I think a lot of people have a misconception of the bank where they think, oh, this people have savings accounts, and then they take that money and they lend it out. But it's like not how it works at all, right? So it's all about fees. It's all about, you know, late fees and check fees and all that stuff. That's where they make all their money in these fees. And then they lever up, right? They're recycling the money.
So who could we go to
To buy notes?
to have a, well, that's the second part of the question. Who can we go to sit down and really go through an analysis of each of our individual situations
Oh, geez.
to apply many of the techniques that you talked about for everybody's benefit?
Well, now you know I wrote the book, and
I
I'm
know
giving
that,
you all
yeah.
a copy, right?
That's a softball question,
It is a
Dave. I'm
softball
giving it to
question.
you.
So I did bring everybody a book, so hopefully you can take it home and read it. But there's a lot of different strategies and ways to get started. And you could tell I was probably all over the place a little bit tonight, but it's really just to get you to expand your mind a little bit into, there's a lot of different ways you can get into the note business. It's $1 trillion industry. It's hard to cover it all in a 200-page book too, right? But it's just like real estate would be, right? Can you imagine me trying to describe all the ways you can invest in real estate in a 200-page book? It's not easy to do, right? Because you can invest in cemetery lots or you can invest in a REIT, right? So it's all over the place when you really think about, especially with commercial real estate. I do some multifamily and commercial investing, and you know, I raise capital. That's really my main role. And I started out in commercial real estate before I got into notes, raising a lot of capital for, you know, mobile home parks, storage centers, and commercial office.
I haven't heard about the cemetery lot business.
Yeah, that's a business.
That's an interesting one.
Yeah, it's real estate, right?
Is that performing or not
It's
performing?
covered under the real estate license, right? So you didn't know you could get your real estate license and sell cemetery lots, right?
So as a younger guy like your son, where do you recommend looking for lower priced notes, maybe less than $10,000 to get your feet wet, just to get a little bit of experience on the note end?
It is harder to find those because
Okay.
obviously anyone can buy a note. You don't have to be high net worth. So the competition's there, right, to find more deals. Privately is the easiest way in some cases, or to start into, you know, crowdfunding sites and things like that. There's plenty of crowdfunding out there to do deals, which is really a piece of a note.
And I've heard some crowdfunding has had some negative stuff going
They
on
have.
recently.
Yeah.
I think, what was it?
Realty Shares
Yeah,
went out of business.
they went under. So
Yeah.
some of that is scary.
Well,
I
it
prefer
makes
to-
sense though. It is and it isn't. So think about Realty Shares, because I knew the CEO from Realty Shares, and Nav, his name was Nav. And the thing with Realty Shares was they grew very quickly. But think about the business model itself. They were doing hard money, right? But couldn't anybody borrow hard money there? And couldn't anybody lend hard money there? You see the problem with that? If we do a hard money deal, we're doing it with somebody that's doing 50 to 100 flips a year. See the difference in experience level? Totally night and day, right? Because do I really want to lend hard money on your first deal? No offense. No, because I don't know what he's going to do. Right. So I don't know if he knows what he's doing. So really that experience, so that's why in my mind, some of those models, they're just technology companies going, hey, I'm going to connect these Yahoos together and hope it works out. And you know what? It's not my money. I don't care. Right. But you saw what happened. They kind of grew too fast. They actually spent more of their focus on the capital side than they did building the business. And that's obviously why it imploded. Now, I don't want to knock them because any business can go through a cycle. You know, I'm lucky. I'm here 12 years. Most businesses fail in the first 5, right? So it's just
but back to my initial question, right?
how do you get started?
Yeah, if I got $10,000 or $15,000, instead of me looking for a property in Philadelphia or a lot to buy, let's just say, and I'd like to put it into a note, where do you recommend, or a marketplace for me to look for that?
Believe it or not, there's a lot of people in the meetings themselves, right? I know my buddy Steve over at Temple. He would do second mortgages on the renovations. He would do he would use private money, like hard money, to buy the first, and he would use a second mortgage for the renovation part. Well, there's plenty of rehabbers that need a second mortgage for additional renovation. Like, Deb will take your money. Somebody will take your money. So it's right here in this room. You just never thought of thinking about it that way. You know what I mean? So there's plenty. It's just like utilizing your IRA accounts, right? We can, let me know when you shut that thing off, but you get the idea. So you can, I can lend money to you, you can lend money to him, you can lend money, we can all lend each other money, and now we just have access to our IRA as hard money, right, basically. Right? There's a lot of strategies. It's all right in this room. How many people in here have retirement accounts? How many people lend money? How many people need money? Kiss each other or something. I don't know. You get the idea, right? Like it's easy. Let's get coffee. I have a buddy that does 8 flips a month. He's been doing 8 flips a month since he was 20. He's like 45 now. And he owns like 300 houses. And I give him hard money for the last, I don't know how many years. I don't even look at his properties. He's got so much property, I could care less. Right? So it's like you need financial friends sometimes. That's really what it comes down to, build a network of financial friends and help each other out. And we all have retirement accounts. We all can help each other, right?
Yes,
we can all lend to each other. So yeah, I'm kind of dodging it's tough when you have a small amount and you're new. It is a capital intensive business, but it doesn't have to be your capital. I mean, Deb's known me for how many years since we started? We were in a tiny little office that's a beer distributor now, right? So, and we grew and we grew and grew and grew. And we built a whole company with none of our own money. So you don't need money. You just need access to money. I'm sorry, were you asking a question?
Do you have a preferred insurance vehicle? Like a while back, I was getting pushed from a salesman for these indexed
I know what you mean.
whole life or indexed the universal lives to borrow against.
There's different strategies on different ones, and
But there's not one that you prefer over others?
well, they fit different people in different ways sometimes. So it's tough to have a one size fits all in any kind of financial planning, unfortunately, because a lot of us have different assets, different investments, and we have different, I call it, what do they call it? Family governance. We just covered that last month at our meeting. Family governance is a big thing, right? Like, who are you, what's the game plan for the family's business or wealth, right? And a lot of us don't really think about it that way. But it's really important, right? And so a lot of what I might set up would be totally different than what you might set up or you might set up or you might, it's.
when I looked into that,
Grandkids, college needs, whatever,
when I looked into that, using insurance, the example that you gave before, it's a wonderful thing if you have enough years to basically pay off all the upfront costs, so until it starts to work in your benefit. But you have to have enough years.
I don't know that I agree with that. There's a lot of different ways. So you think about insurance. Anybody sell insurance in here? There you go. So now I can beat you up. But now you know how to get free insurance for your clients, right? So one of the interesting things is, most insurance is sold based on premium, right? So, or I'm selling the products my company has to offer. So you're kind of captive in that way, unless you go to someone that is more of a broker that can give you a multitude of products. But it's just like the infinite banking concept, and there's different versions of that, and not everybody agrees with that. But you can kind of become your own family bank and your own business bank. You can do it with key man policies between partnerships too. You can funnel a lot of money into those policies. You can have the business own it. You can have the different partners own it. You can have the retirement account of your employees can lend you the money to buy the policy, and you pay them back upon your death, right? So there's all kinds of crazy strategies that you can do, just like you could do charitable remainder trust on your properties. You could be in accumulation mode right now, and you get to be 80, 90, whatever, and you go, I've had it. All right, I'm ready. I'm done. And you might go, well, my favorite charity is, I don't know, Villanova, where I went to school, or wherever that is, right? And you could do a charitable remainder trust, sell your properties, big taxable event, donate the proceeds into an annuity to the charity. You and your wife could live off that. The school gets the donation. You paid no tax. You're out of the property business. And you got plenty of money in insurance. They can buy policies with that and fund your heirs. So there's all kinds of strategies. You don't have to, just sit there and go, okay, I'm just going to leave all these properties to my family, and they're going to fire sale it as soon as they throw the last shovel of dirt on me. So, that's really not a strategy. That's a cop-out, right? So
That's from the
That's not in the book.
That's
but-
from the grave that you bought
Yeah.
earlier. Okay.
Yeah, there you go. They do go up. I don't know if
So
it's
everything,
platinum in advance.
there's a full circle for everything.
Yes.
Any other questions for Dave? Okay, grab the mic, please.
Kind of along those lines, because that's mainly what we do is show people how to utilize insurance to buy real estate. Have you ever used real estate as, or like a whole life policy as a sweep account instead of using a HELOC?
As a sweep account, you probably could. I never thought about it. You could you use it as a checking account, drop money back in it, pay it back, and then you write a check when you need it. Yeah, I don't see why not. You could you could borrow money out of the policy to pay down your first. The only difference there is interest on a HELOC, for example, is computed differently than a fixed rate mortgage. So it's the daily average. So it's computed a little differently. So you, by dropping your paycheck in there, you never have to make a payment, and then you're paying it down, and then you're only borrowing it, and it's that movement of the money. I don't know that you'll get that same effect in that. Now you can do a sweep account, like say you don't own a house and you have an auto loan or a student loan, and you want to pay it off in a fraction of time. You can use a credit card as your sweep account, and the credit card will act the same way. But if you notice, credit cards. I have one buddy that carries like 3 credit cards in his wallet, and he has like the dates on them. And the reason he does that is there's a starting date and I forget what they call it on your credit card statement. For the cycle, and he plays the cycle. He gets like 60 days interest free. I know when I had my painting company, we would buy like 60,000 a year in paint. The paint stores would give us 30 days, and then we'd put that on a card, and then we'd go on vacation. Get all the points But we would throw the 60,000 in paint. I'm sure you guys do that with materials too. Home Depot. I knew many a builder that would put all the supplies for the whole development on credit cards, and then go to Europe for the summer or something. So yeah, I don't know if I'm answering that question, but you can play that game as well. And if you combine a bunch of these finance hacks, it really starts to add up.
There's a limit to how many cycles you can go through before TransUnion or one of those catch on to you and write it up on your report.
As what? That you use the card? I mean, I don't know.
Well, so you buy your 30 days from Home Depot, pay it with so in 28 days you pay it with one credit
if you
card.
transfer it from one credit card to
and then
another?
28 days
Well, I didn't
later you
really-
pay with another credit
No,
card.
I didn't really mean that.
Oh, okay.
No, I
Then
didn't
what
really
did you mean? I misunderstood you.
No, there's a credit card cycle, and you can call your credit card company and find out what the cycle is. So, for example, if the cycle on my, I don't know, MasterCard starts on the 15th of the month, well, if me and my wife go out and buy new furniture, do I buy it on the 14th of the month or the 17th of the month? And there's a dramatic difference and a lot of people aren't paying attention to that, right? So I get an extra month free interest that way. Like, because if I buy it at the right time of the cycle, plus get so some people play that cycle. Most people don't play any cycle, right? So they play a cycle, all right? They just go to work and pay their bills, right? So, but you get the idea. You can play the cycle on a credit card. And if you have more than one card, you can play, well, if it's this time of the month, I'll put it on this card. If it's this time of the month, I'll put it on that card, that kind of thing.
Any other questions? Yes. Take a microphone there, please. So you're mic number 3. Okay, go ahead.
You mentioned auction.com as a source, and I think that's something we all have access to. And could you speak a little bit to that?
I've never bought a note there, but I know they sell them. And they always approach us to sell.
Notes for
They sell properties.
properties
Yeah.
or notes? Or
Well, we sell REO too. Yeah. So we sell both.
when you sell through there, so,
I never have, but you can.
okay.
FCI Exchange was another one. Now they just changed the name of that too.
I'm just unsure if they're going to give you title through that. I know that they allow you to get title, but
You mean what's it look like paperwork wise when you buy a note? You'll do it's similar to real estate. In real estate you have an agreement of sale and you have a deed, pretty much. That's the bulk of it, right? And then you have a note mortgage or whatever. But when you buy a mortgage, you're going to have a note sale agreement, which is similar to the agreement of sale. It's just a note sale agreement. And the recording document is just an assignment of mortgage. And you also see an allonge. Allonge is the note trail.
Could you also just speak real briefly to rehabbing a note, what that means?
Rehabbing a note is usually you bought a non-performing note and you got it reperforming. So you rehab the paper instead of rehabbing the house. So when you're in the note business, you're doing everything from phone and computer. When I first started out, this is going to sound funny, I just had a laptop and a Magic Jack. And the Magic Jack had my 800 number, and I would talk to homeowners through Magic Jack, which is crazy when you think about it. But you're really doing, it's like you're doing the We Buy Houses business by phone and computer instead of in their living room. And it's a little different because you know how you're in their living room, and if it has equity, you can work a deal with them somehow, is really what's happening. In the note business, it's a little bit different because in the We Buy Houses business, they could say, no, I don't want to deal with you. I changed my mind. In the note business, you own the asset, right? So you got this, I don't want to say foreclosure thing going on, but you do. Not that you're using it in a bad way. It's just that, you know, you can get their attention, right? Or there's a time limit there. So time runs out or whatever.
Did that answer your question? Okay. Any other questions? Okay. Go ahead, Steve.
Can you give me the contact information for Affinity Insurance?
Oh, geez. Possibly. Let me see if I could. They're in Kansas City, so if you Google them, they might come up.
There were a lot of.
Is it really?
Why are you such a fan of them? What's the model?
Because they do nationwide. If you go to, I can give you their website. It's www.nreinsurance.com.
Does that answer your question?
Yeah.
You were saying, why do I like them? Because I can say, did you ever go to a local insurance agent, like, I don't know, State Farm, Nationwide, something like that, right? And you go, I want to insure a vacant property. What are they going to say? I want to insure this. I want to insure that. What do they tell you? We don't like that. This whole company is based on the I don't like. They built the whole company around that. So it's the opposite. They're like, no, we love all property. We love, even when you own the loan, you can insure the property. Like you can have an insurance policy even on your note. You can have, you know, a lot of times, especially if I have low end mortgages, I have the property, you know, I can get like really low, I can get just liability coverage to protect my multi-million-dollar fund without having to put coverage on a property I own, especially a junior lien. So what's the worst thing that would happen if I bought a second mortgage and I didn't have insurance and the place burns down? Payment goes to the first, but what do I have? The lot. So most times the lot's worth more than my note cost was. It's a very low risk for us. No, not if we foreclosed and own the house from second position, and the place burns down. So do I really need insurance? Yeah.
Please use the mic.
Sorry.
No, not you. Our questioner.
So it depends, right? You got to put it in perspective again, because you're going to end up with the lot, and most lots are worth more than the assets. I know it's a little bit street version of reality.
So Dave, sort of to wind things up, can you give us a short list of, in addition to your book, other books or videos that we could watch to educate ourselves on these various topics?
Well, there's plenty of note groups and Facebook groups, and there's note conferences, Paper Source, Note Expo in Dallas every year. There's a distressed note conference in North Jersey. There's one in Southern California every year. It's a smaller network, for example. Like I look at like the DIG main group, that would be like a nationwide group would be about that size, you know, it might be, you know, so it's a smaller arena, so to speak. And a lot of the note folks all know each other. But there are online groups, Facebook groups, LinkedIn groups. We have a LinkedIn group on distressed second mortgages. There's a group on Bigger Pockets, for example. I'll answer people's questions all the time. So if you guys have any note questions, you can always go to Bigger Pockets and ask. And, or in our group on LinkedIn, that type of thing. So there's plenty of people that that'll walk you through a deal or JV with a deal. A lot of especially first mortgages. There's plenty of people that look for money partners that don't want to do the work, and vice versa. So there's always good people to partner up with. Either they need capital for the note, or they need somebody to work the note, and they have the capital. So that's the easiest way, really.
Will you be able to stick around for a little while?
Yeah, sure.
Before people leave the building?
Yeah, I mean, the last thing on that, I would shadow someone's deal before I would go venture in, do a deal, and lose my money. Don't do that. I think it's smarter. It's the same way rehabbing a house, right? It's much easier to go on a property tour, a dig, or something like that, right? Than to go, hey, I'm going to venture in and just... No, I get you have to pull the trigger at some point. We all do. But I think it makes a lot of sense for you to learn off him. He's renovated 50 houses. You're on your first house. Go see what he's doing. He'll take you there and buy him lunch or something. You get the idea.
Okay, Chris, last question.
Can I do two? Real quick, if somebody's thinking of getting in the note business, like obviously there's economies of scale. So where is a safe economy? Like you say, hey, you want to get invested in notes, you should have 100, you should have 250. Where should somebody focus to get a business going?
No, that's a good point. I mean, the more you have, the better. A lot of times, even when we started out, we started out with a couple of us pulling our own money, and then we started raising other people's money. But I remember doing JV note tapes with people. This guy Mike out of North Jersey, he was learning the business same time we were. He would actually pull a bunch of investors together. We would buy a larger tape. We would get discounted rate because we're buying larger tape, and then we would hack up the assets. We had like a little mini lottery thing, right. And it does work out that way.
Right. But what kind of funds was that? Was that like 50 grand or 150 grand or $1 million? Yeah, we might raise $1 million or so. $1 million's a good number.
Yeah.
To kind of get started.
Most of our trades today are 5 to 20 million a trade, probably.
Right.
For us.
So second question is, I know when you started, you did a lot of distressed seconds, and can you talk a little bit about the market and the timing right now? Is that something you recommend in this economy?
Well, there's not as many of them, and they haven't been writing them for a while, so it's harder to find a lot of seconds. And seconds are more sporadic. It's not as much consistent deal flow, but if you're a smaller investor, it might not matter.
But where we're at in our market cycle, looking at the potential of maybe some correction in the next year or two, is that something that you have to be concerned about?
Yeah, we're hoping it happens.
But
Correct away.
But if a little guy's getting started with distressed seconds, that's a liability at this part in the market, right?
Well, that happened to us, right? So when we started in 2007, it was an up market for us, and there's a lag with distressed debt. So when the real estate market tanked, note business there's like a 3 to 5 year lag, right? So our lag was like 2009, right? Like that kind of thing. But what ended up happening is, I'll give you a good analogy. It would be like, I have a $100,000 rental property. It rents for $1,000 a month, and now it drops to $80,000. Oh crap, right? But is it a problem if I'm collecting $1,000 a month rent, or okay, $975? No, it's only a problem when I have to sell it. Well, the same thing happens in a note portfolio, right? You own all these notes. Sure, did we, crap our pants? The value of our portfolio dropped. And we're like, oh no. But what we found was the outcomes didn't change much, right? And a lot of the reasoning is because of emotional equity, right? So just because, if you live with your family for 10 years in this house and all of a sudden it's not worth 150, it's only worth 100, does that mean you just leave? No, you need a place to live, right? Does it make sense to stay there? Maybe, because I would need first month, last month, and a month security to go move or whatever. Costs money to move, right? Plus there's emotional attachment. Maybe I finished the basement there. Maybe I raised my kids there, right? Emotional equity. It doesn't make sense. It's like when an old guy like me buys a red sports car to go pick up girls, right? And I drive off the lot and it drops in value. Do I still make the payments? Yeah. Does it make financial sense?
Does it work?
No, it doesn't work. It doesn't work.
Because then it's worth the money.
I think I got the same girl still, so it doesn't work. But no, you get the idea, right? That's emotional equity. That's a perfect example of doesn't make any financial sense at all, but dumb guys do it, right? So.
Girls like
hey,
yellow.
wait a minute. I bought a red convertible.
Girls like yellow cars, not
yellow
red cars. Anyway, let's give Dave a great round of applause. Thank you,
Yeah.
Dave.